Outside the US, the banking system is a lot more concentrated. US has always had a lot more decentralization in its banks because we have these institutions called community banks. A lot of people leg into Bitcoin through ETFs or through wrappers, financialization wrappers and they think they own Bitcoin, but they don't really, because they're not controlling their private keys. In order to really own Bitcoin, you have to control your private keys. Otherwise, all you own is an IOU, and you've just recreated the same problems that were in the existing system. Your ability to own your own Bitcoin and to be a true first-class citizen of the Bitcoin ecosystem. Only those who control your keys are the first-class citizens.
Are traditional banks on the verge of collapse? Caitlin Long, CEO of Custodia Bank, reveals how Bitcoin is exposing cracks in the financial system. From outdated banking practices to Bitcoin's rise as a decentralized alternative, this conversation uncovers why Bitcoin could be the ultimate disruptor. Stay tuned to learn how Wall Street's strategies, SEC regulations, and Bitcoin ETFs could shape the future of money.
If you look at the Fed's aggregate data in what's called the Z1 report, large banking organizations have about 12 cents in cash against their demand deposits. So it would only take 12% of their demand deposits to run for them to need extra liquidity. And that's the larger banks. The smaller banks, it's about 8 cents. So in aggregate, it's somewhere around 10 cents, a little over, because the larger banks are quite large. But there are so many more smaller banks in the United States. So huge quantity of smaller banks. Outside the US, the banking system is a lot more concentrated. US has always had a lot more decentralization in its banks because we have these institutions called community banks. There's something around 10,000 community banks and credit unions, and then of course the large banks. But the large banking organizations have more than half of the deposits. They have something like 95% of the payment volume on the ACH rails. They're absolutely dominant. Even like the top 5 banks just dominate. So it's an unusual banking system. So anyway, with that backdrop, the numbers I gave you, call it on average 10 cents. Those are the reserves. So your point is well taken. There's no reserve requirement anymore in the banking system. The Fed reversed that a couple of years ago. But there's a capital requirement and there are liquidity requirements. So it's not as though it's freewheeling and there's no regulation. In fact, the banking system is the most over-regulated industry in the United States. Everything is prescribed. That's also why the tech is so backwards, and it's also why there's almost no innovation. And so they look at people like me who, worked inside the banking system for a long time and tries to go innovate from within, and they try to chew you up and spit you out because they don't want innovation. The current set of regulators is very anti-technology innovation, and there's a lot of regulatory capture, unfortunately, at the federal level. Unless you're using Bitcoin native rails, that's going through the old school systems, which are not even API based. So it's really antiquated. What's happened in the US is that the fintech industry has created these technology enabled applications that we're so used to using, including something like a Venmo or a PayPal. But what's happening is on the back end, all of the actual payments are still running through those old school rails. And there hasn't really been innovation in the payment system since the 1970s. And there's a movement in Congress that Richie Torres put forward a bill in the US Congress to give the remittance companies direct access to the payment rails and to FedNow, as opposed to having to go through the banks. And the problem with something like that, I know from having dealt with trying to integrate into the Fed, trying to get access to those same payment rails, is there's a gigantic technology mismatch. A lot of people leg into Bitcoin through ETFs or through, wrappers, financialization wrappers and they think they own Bitcoin, but they don't really, because they're not controlling their private keys. So in order to really own Bitcoin, you have to control your private keys. Otherwise, all you own is an IOU, and you've just recreated the same problems that were in the existing system.
Caitlin Long dives deep into why traditional banking struggles to keep pace. She highlights how antiquated systems and regulatory bottlenecks prevent innovation, keeping large-scale transactions painfully inefficient. But Bitcoin offers a revolutionary solution, challenging fractional reserve banking and empowering individuals through self-custody. She also touches on the ETF debate, revealing its potential risks to Bitcoin's core ethos. Stick around for insights on Bitcoin's geopolitical power and why it's more than just digital gold, it's freedom money.
Bottom line is Bitcoin is an asset with no entropy. Michael Saylor talks about this as well. It doesn't degrade. Exactly. Yeah. So it's not just that you're getting ahead of inflation because the inflation rate of Bitcoin is half of the inflation rate of gold right now, which is a fraction of the inflation rate of most fiat currencies. That's absolutely true, but it's more than that. It's that there is no degradation, there is no entropy. If you own real estate, if you own commodities, you're going to have some maintenance costs. You're going to have some shrinkage in the corn that's never 100, not every kernel is going to make it from the farm to the table in the transportation, right? You're going to have degradation, and every hard asset has that. Yeah. And gold in particular has a lot of transaction costs because transportation costs are high. You've got to buy insurance and you've got to assay it, all of those things, right? But you just don't have that with Bitcoin. So I look at all this coming back to the self-custody question and your ability to own your own Bitcoin and to be a true first-class citizen of the Bitcoin ecosystem. Only those who control your keys are the first-class citizen. Everybody else is a second-class citizen, and then what you've done is cede control to a leveraged counterparty that may not have the same interest as you. And this is where we get into some of the debates about Bitcoin. What if there's a contentious soft fork again? UASF, right? We users of the Bitcoin network, the people who run the nodes, it's not just enough to custody your keys. You're really only a first-class citizen in the Bitcoin ecosystem who run a full node. And the node users were the ones who voted with our feet on the UASF soft fork, right? And what if there's going to be something like that coming up and it's a Bitcoin custodian who has to vote with their feet at that point? And even like institutional custodians, this is so fascinating that Saylor doesn't talk a lot about self-custody. And that's one of the challenges. I'm quite sure he's thought about it. But when you realize that one of the biggest risks to MicroStrategy or to the ETFs is just the custodians being hacked. Now, it's a really interesting and very different way to think about risk that I don't even think most of the people on Wall Street are even thinking about. It would be good for our market. That's one of the mistakes the SEC did do. And in fact, actually, they forced a problem in the banking system. This is going to get a little bit esoteric, but you're going to now understand why Silvergate and Signature, the two U.S. banks that serve this industry, were so important to this market. And in particular, the SEN and Signet networks, which were 24/7, 365 networks, because the SEC forced onto the ETFs cash creates. So this is what you're talking about. Exactly. In the Hong Kong ETFs, they are allowed to physically create the ETF unit. So stop and think about the cash flows. You can go Bitcoin to ETF, ETF to Bitcoin, back and forth. Okay. In the US, you go Bitcoin to cash to ETF unit to cash to Bitcoin, right? So they threw in the extra step. Why did they do that? Because Gary Gensler hates us and he did not want the broker dealers to touch Bitcoin at all. So the only thing they can touch is cash. And so therefore and they can touch the ETF units. So he ring-fenced the exposure, Bitcoin exposure outside of the regulated broker dealers and banks, which is what creates the FTXs and other frauds of the world. But I digress. So anyway, long story short, that he thought he was throwing sand in the wheels because of course he hates this industry and he's trying to throw sand in the wheels. What he did was he created a big problem for the banking system. Why? Because you've got market makers in the ETFs like Goldman and like Jane Street, some big names on Wall Street, not just regulated banks like Goldman, but hedge funds and trading firms as well. But these firms are all big players on Wall Street, okay? Here's the problem. Bitcoin trades 24/7. FedWire is only open during banking hours. So what happens at 2:39 a.m. on a Saturday? You're going to trade Bitcoin, but the US dollar leg is not going to settle. And remember, because of the cash creates, everything has to go in and out of US dollars. So therefore, there's a bunch of unsettled transaction exposure. Last time I did the math, it was about 5 billion a day. Now that doesn't sound that much. Probably doubled or tripled that right now. But I was looking at after hours volume and assuming that the other side of the after hours volume, a certain percentage of the after hours volume is the ETFs, and it has to go through dollars because of that cash create piece. So long story short, you've got big players with unsettled transaction exposure waiting for FedWire to open to clear those unsettled trades. This is why Silvergate, SEN, and Signature Bank's Signet were so important. There's only one of those networks right now. It's Customers Bank's CBIT. There are others trying to create them, and bank regulators have been throwing sand in the wheels because they hate us. They want us all dead. That the Peter Schiffs of the world don't recognize that Bitcoin is a digital good. And that is a good that is evolving to become a commonly accepted medium of exchange. To a lot of people in the world, Bitcoin is money already. I acknowledge it's digital gold. But to a lot of people, to people in Nigeria, to people in Argentina, to people who in Venezuela who are living in Iran, people who are living in high inflation economies, they don't look at it as digital gold. They look at it as a path to survival. And it's also interesting, this is a separate but related tangent, that some people, like in Venezuela, there was a big story that came out probably 2 years ago now about people mining Bitcoin to be able to get Tether and to be able to get USDC. They were using Bitcoin as the means to get a US dollar. We think of that as backwards, right? And so which comes first, the chicken or the egg? I actually very much do believe medium of exchange comes first, store of value comes second. But that's because I believe in the Misesian regression theorem.
Caitlin Long's insights show that Bitcoin isn't just another financial tool, it's a paradigm shift that's shaking the foundations of global finance. Whether it's the risks of custodianship, the SEC's influence, or Bitcoin's role as a reserve asset, the message is clear. Bitcoin is changing the game. Don't miss more groundbreaking discussions on the future of money. Like, comment, and subscribe to join the conversation.